Hi and welcome to Swissquote's daily market talk. It's August 8th. Sentiment across stocks remains mixed, with AI boosting demand for technology stocks, decline in oil prices weigh on energy stocks on the other hand, but futures are pointing to a positive session today as Donald Trump's new Fed choices are unsurprisingly dovish. So we will talk about all that and more, but before we do, please keep in mind that opinions are my own and this is not financial advice. So European stock markets gained yesterday on hopes that Donald Trump might broker a meeting between the Russian President Vladimir Putin and the Ukrainian President Volodymyr Zelensky. However, Putin has not yet agreed to dialogue directly with Kiev, and the latest reports actually mention that he won't move ahead. Regardless, US crude is now below a key support level and falling at the time I'm talking this morning on rising hope of progress, a move that could rapidly reverse, however, as Russia looks much less enthusiastic to end the war in Ukraine than Trump is. Meanwhile, in Europe, the defense stocks that have been so popular this year are coming under pressure, and they were actually under pressure yesterday due to disappointing earnings from the German Rheinmetall. German Rheinmetall, remember, has been one of the most popular European defense stocks this year, as the United States under Donald Trump actually pulled back from its security engagements with Europe in a historical manner, and the European governments and NATO, as a result of it and on Trump's demand, pledged to increase their military spending to 5% of their GDP. So the delay in passing the spending budget with the new German government and the NATO summit that ended with that 5% of the GDP pledge for spending are said to have delayed orders to the second half of this year, but investors didn't want to hear an excuse, so the Rheinmetall stock price fell 8% yesterday to its 100-day moving average level. Other defense stocks in Europe printed mixed results in the second quarter of this year as well, with Leonardo raising its forecast, BAE Systems upgraded sales and growth forecast, while the French Dassault Aviation missed expectations. But overall, the outlook for European defense activity remains positive, but the valuations across the defense stocks may have gone a bit ahead of themselves. Elsewhere, however, the STOXX 600 index rose and closed above its own 50-day moving average yesterday, and even the Swiss SMI index rebounded despite the news that the Swiss left Washington a day before, having no better deal in hand than the 39% tariffs on their United States exports. I believe that gains across European indices remain fragile, however, given that the tariffs will have real-life implications for the underlying European economies, and my best guess is that the central banks, the SNB and the European Central Bank, will step in to help supporting the underlying economies. But while the side of the 39% tariffs increases the chances of negative rates from the Swiss National Bank in the second half of this year, expectations for the European Central Bank actually remain mixed. The ECB will likely do nothing at its next monetary policy meeting in terms of rates, but could announce one or two more interest rate cuts into this year. And while European inflation remains under control, partly helped by a stronger euro since the beginning of this year, numbers actually diverge across the euro area, which could eventually complicate the decision making at the heart of the European Central Bank. But I still think that the policy bias at the ECB will remain sufficiently dovish to prevent putting more pressure on the underlying economies at such a complicated time, and that should somehow continue to give a support to the euro. Across the Atlantic Ocean, while sentiment was less cheery yesterday than in Europe, yes, as energy stocks, for example, followed crude oil lower, then the data didn't help either. The weekly jobs data showed that the initial claims jumped to the highest level since November 2021 in the US, while a monthly survey from the Bank of New York suggested rising inflation expectations due to tariffs. So that's the combination that economists call stagflation, high inflation and high unemployment, and should, in theory, lead to a cautious stance from a central bank. But who cares about the economic theory, right? At a time when Trump writes the new rule book, because futures are in the positive this morning. At the time I'm talking here on NewsAd, Steven Mnuchin will be replacing the outgoing Adriana Kugler at the Fed, and Christopher Waller's name actually comes under the spotlight for the next Federal Reserve chair, and both men are dovish, and both men will help Donald Trump's rate cuts no matter what dream to come true. So the US 2-year yield is not reacting much this morning to the latest Fed news, and I know that I keep repeating this, but note that interest rate cuts do not necessarily lead to lower borrowing costs if especially they are not justified, and in an environment of rising inflation expectations, they may not be. Because remember last September when the Fed went crazy and cut the rates by 50 basis points with no apparent reason to back that decision, the US 2-year yield had jumped around 30 basis points in the 2 months that had followed that decision. For now though, note that September is expected to bring the next Federal Reserve rate cut, and that actually keeps the S&P 500 near a record high level regardless of the tariff uncertainty and policy inconsistencies. But note that many analysts out there, many big bank analysts have just started sending warnings about a possible 10 to 15% pullback in the S&P 500 prices in the coming months, as the seasonality also plays against further gains across the S&P 500 companies, as the months of August, September and October are seasonally calmer months for the S&P 500 stocks, but most of them still say that any price pullback today will be an opportunity to buy a dip. See, when most investors cannot wait to see a dip to buy it, markets generally don't dip much, as many investors just don't sell their holdings and the sell-off remains soft enough not to trigger margin calls. So we are pretty much stuck in this positive spiral in the market pricing for now, and AI obviously remains a major driver of gains, because in Japan the Nikkei index is up by 1.70% this morning, while the technology heavy topics index just surged to a fresh all-time high level in Tokyo after SoftBank rallied to fresh record high levels after announcing that it returned to profitability last quarter. Sony also flirted with an all-time high level this week after raising its full-year profit forecast despite tariffs. Toyota investors, however, were much more concerned with a 37% fall in company's profits amid US tariffs. All in all, technology is and continues to be that safe island, that safe virtual island, even though the valuations here are quite high. The AI-related demand remains strong for sure. Spending remains robust for AI, and some companies like Meta, for example, actually managed to turn their investments into revenue. So that's something that pleases investors. Elsewhere in technology, well, a basket of US chip makers reacted positively to Donald Trump's 100% tariffs yesterday, as Trump exempted those companies that are investing in the US from these hefty tariffs. Nvidia, for example, flirted with a fresh all-time high level, while AMD shrugged off its post-earnings sell-off. On the currency front, while the US dollar remains under the pressure of trade chaos, weak bond auctions of the week, and the dovish Federal Reserve expectations, although we see some rebound in the US dollar across the board this morning, the euro dollar actually consolidates its gains after a 2% rebound since the beginning of August, while sterling extended its gains against both the US dollar and the single currency yesterday after the Bank of England delivered a hawkish interest rate cut, because 4 members at the MPC voted to keep the interest rates unchanged. That's way more than expected by analysts. So that vote, along with the expectations that the British inflation will hit 4% in the coming months, basically washed out the November interest rate cut bets and sent sterling higher yesterday. Now note that we are back to hawkish expectations leading to higher currency valuations in the context of re-rising inflation in the UK and in the US, whereas the beginning of the year has seen this relationship reverse, and especially for the euro, and it remains kind of mixed for the euro still, mind you, because traders actually see the dovish European Central Bank boost European growth expectations, and that's leading to a higher euro. But that is no longer true for sterling, and that is no longer true for the US dollar either. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.